Here is how every accounting exam actually ends. One giant problem, a brand new business, a pile of transactions, and one instruction: take it through the full accounting cycle. Journal entries, T accounts, the trial balance, adjusting entries, the financial statements, and the closing entries. 7 stations, 1 story. Tonight we solve one complete problem. Start to finish, every number derived on screen, nothing asserted, everything proven. And there is a prize for staying. By the end, all of chapters 1 to 4 fits on one cheat card. Screenshot perfect. Stay to the end and I will hand it to you. But first, someone just opened a bike shop and they have no idea what is coming. Meet TrueWheel Bike Repair. On March 1st, 2026, Sam Doyle quits his desk job and opens a small bike repair shop. Our own shop, our own numbers, 100% original and built for this lecture. During March, the shop has 12 transactions. Sam invests money, buys equipment, pays rent, buys insurance and supplies, takes a deposit from a cycling club, bills customers, pays his mechanic, and takes money out for himself. If you want to work this with me, the complete problem sheet is free on the site. Link in the description. Pause here, grab it, and race me. Our instructions are the full ride. Journalize all 12, post them, prove a trial balance, record every type of adjusting entry, build all 3 financial statements, close the books, and prove the post-closing trial balance. Everything ahead stands on just 2 old ideas: the accounting equation from Chapter 1 and debits grow assets from Chapter 2. If those feel fuzzy, both chapters are linked below. If you own them, you are ready. So grab a coffee from the shop we built in Chapter 1 and let us get to work. 60 seconds of review first, because the whole problem stands on it. Assets equal liabilities plus equity. Everything the shop owns is financed by someone, creditors, or the owner, and that scale never tips, not once, through everything we are about to do. Expand equity and you get the full map, 6 account types. Assets, drawings, and expenses grow with a debit. They live on the left. Liabilities, capital, and revenue grow with a credit. They live on the right. One word holds all of it: dealer. Drawings, expenses, assets on the debit side. Liabilities, equity, revenue on the credit side. That is every rule of Chapter 2 in one breath. Say dealer out loud once, seriously, say it, and let us meet transaction 1. March 1st, Sam puts $15,000 of his own cash into the business. Watch the method here, because we will run the exact same 4 questions 11 more times. Which accounts are touched? Cash, an asset, an owner's capital, equity. Which direction? Cash goes up, the business is holding the money now, and capital goes up, the owner's claim was just born. Now the rules. Assets grow on the debit side, so cash is our debit. Equity grows on the credit side, so owner's capital is our credit. The entry writes itself. Debit cash, $15,000. Credit owner's capital, $15,000, indented underneath, always. And check the equation. Assets up $15,000, equity up $15,000. The scale stays level. It is the same move Maple Bean Coffee made in Chapter 1 with its opening deposit. Derive, never memorize. That habit is the whole course. Same day, March 1st, Sam buys his repair equipment. The workbench, the stands, the tools, $7,200 in total. But here's the twist. He only pays $2,200 in cash. The other $5,000 goes on account. The supplier agrees to wait. Nice people, tool suppliers, at least until the invoice is due. 1 purchase, 3 accounts. This is a compound entry, and it is where Chapter 2 students start to wobble, so baby steps. Which accounts? Equipment, an asset. Cash, an asset. Accounts payable, a liability. Which directions? Equipment goes up by the full $7,200 because Sam owns all of it from day 1, no matter how he paid for it. Cash goes down $2,200, and accounts payable goes up $5,000, a promise to pay later. Now the entry, and debits come before credits, always. Debit equipment, $7,200. Credit cash, $2,200. Credit accounts payable, $5,000, and notice each credit gets its own indented line, never squeezed together. And prove it before you move. Debits, $7,200. Credits, $2,200 plus $5,000, $7,200. It balances. Pause on that for a second. Let it settle. From my teaching days, this was the most common slip on exams. Students debit equipment for only the cash they paid. No, the asset is what you own, not what you paid today. March 2nd, 2 payments, and they look almost identical. $950 for March rent, $3,600 for a 12-month insurance policy. Same day, both cash out the door, and yet one is an expense and one is an asset. Knowing why is half of Chapter 3. And if this one feels slippery, that is normal. It trips everybody the first time. So lean in and take it slowly. The rent buys March, and we are standing in March. That benefit is being used up right now, so it is rent expense. Expense up, debit, cash down, credit. Debit rent expense $950, credit cash $950. The insurance is different. It buys 12 future months of protection, and on March 2nd, none of that is used yet. A bundle of future benefit the shop owns is not a cost. It is an asset called prepaid insurance. Think of it as 12 slices in the freezer, and the shop will eat one slice each month. Debit prepaid insurance $3,600, credit cash $3,600. No expense today. Keep that little word "yet" in your head. The expense will come one slice at a time, and catching those slices is exactly what adjusting entries are for. We just planted Chapter 3, and we will harvest it tonight. March 4th, supplies arrive. Brake pads, cables, chain lube, $1,300 worth bought on account. Supplies are the shop's pantry, an asset until you cook with them. Asset up, debit supplies $1,300. Liability up, credit accounts payable $1,300. Now March 8th, and this one is my favorite trap in all of accounting 1. The Ridgeline Cycling Club walks in and pays $800 cash upfront for 10 tune-ups at $80 each to be done over the coming weeks. Cash is in Sam's hand. Before I show you anything, decide for yourself. Is that $800 revenue or is it debt? Lock in your answer. It is debt. The shop holds the money but owes the work. 10 tune-ups of it. Until a bike is actually fixed, that money is a liability called unearned service revenue. Debit cash, $800. Credit unearned service revenue, $800. Think of a gift card. When a coffee shop holds your $25, it has not earned it. It owes you drinks. Revenue follows work, never cash. Half of tonight's adjusting entries stand on exactly those 5 words. March 12th, and the shop is humming. Sam finishes a stack of repairs and bills customers $4,700 on account, meaning they will pay later. Here is the mirror image of the gift card rule. The work is done, so this is revenue, even though not $1 of cash has moved yet. Debit accounts receivable $4,700. An asset, money customers now owe you. Credit service revenue, $4,700. Revenue follows work in both directions always. Then March 16th, Sam pays his part-time mechanic $1,900 for the first half of March. That work already happened. The benefit is fully used, so it is an expense right now. Debit salaries expense $1,900. Credit cash $1,900. 2 entries, 1 principal. Revenue when earned, expense when incurred. Chapter 3 gave it a name, accrual accounting, and you just applied it by instinct. Nicely done. Now the settling up. March 19th, Sam pays $2,000 toward what the shop owes its suppliers. A liability is shrinking, and Chapter 2 says liabilities shrink on the debit side. Debit accounts, payable $2,000, credit cash $2,000. Notice what did not happen there. No expense. Sam is not buying anything new. He is paying off an old promise, and the asset was already recorded the day it arrived. March 22nd, the mirror image. Customers pay in $2,750 of what they owed. Debit cash $2,750. Credit accounts receivable $2,750. And notice again, no revenue. That revenue was earned back on March 12th when the work was finished. Today is just the cash catching up with it. Settlements move cash and promises, they never touch revenue or expense. Exams test that exact sentence every single year. 2 more, and the journal is complete. March 26th, walk-in repairs, finished and paid on the spot. $1,750 cash, work done and cash in, same moment. So revenue is earned right now. Debit cash $1,750, credit service revenue $1,750. Easiest entry of the night. Then March 31st, Sam takes $1,050 out of the business for himself. Groceries, rent, his own life. That is not a business expense. The business received nothing for it. It is a drawing, the owner pulling his stake back out, and drawings grow on the debit side, the D in dealer. Debit owner's drawings $1,050, credit cash $1,050. And that is 12 transactions, 12 balanced entries. The journal is done. But a journal is a diary, a story in date order, and you cannot read an account's balance off a diary. Time to get organized, time to post. Posting is just sorting, and we do it entry by entry in date order, exactly the way the journal was written. Entry 1 first, then entry 2, straight down the diary. Every line flies home to its accounts page in the ledger, and the busiest page in the book is cash. It always is. Money never sits still, so watch every number land on the T account. In from the left, the debit side, the money that arrived, Sam's $15,000 investment, and the club's $800 advance, then the $2,750 collected from customers, and and the $1,750 of walk-in repairs. Out on the right, the credit side, the money that left. $2,200 for equipment, $950 rent, $3,600 insurance. Then $1,900 salaries, $2,000 to suppliers, and $1,050 of drawings. Now total both sides and let the balance fall out. In $20,300, out $11,700, balance $8,600. Sitting on the debit side because cash is an asset, and Chapter 2 says assets keep a debit balance. That number is now a fact, and we will carry it all the way to the balance sheet. 1 page down, 11 to go, and they all post exactly the same way. Here is the whole ledger, 12T accounts. Everyone totaled the way we just totaled cash, and notice the order they are laid out in. Not alphabetical, and not the order things happened. We sort them by the expanded accounting equation, because that is the order every trial balance and every statement will use. Assets first, cash $8,600, accounts receivable $1,950, and notice where that comes from. The $4,700 billed minus the $2,750 collected. Supplies $1,300, prepaid insurance $3,600, equipment $7,200. Then the liabilities. Accounts payable $4,300. The $6,300 owed minus the $2,000 paid, and unearned revenue $800, the club's tune-ups we still owe. Then owner's equity, capital $15,000 and drawings $1,050. Then revenue $6,450. And last, the expenses, salaries $1,900, rent $950. Now look at the small number sitting beside every figure. That is the entry it came from, the posting reference. Real ledgers print it, and here is why you should too. When a trial balance refuses to balance, you do not hunt blindly. You take the account that looks wrong, read the little numbers, and walk straight back to those entries. It turns a 20-minute search into a 30-second one. Look across all 12 now. Every balance is sitting on its normal side, its dealer side from Chapter 2. Now, Chapter 2 taught you to ask one question before trusting any of this. Did the debits actually stay equal to the credits? There is a machine for that, and it is next. The trial balance. One list, every account with a balance, in chart of accounts order, the same order we just sorted the ledger. Debit balances land in the left column, credit balances in the right, and if our double entry held, the two columns must agree to the dollar. Read it down. Cash $8,600, debit. Accounts receivable $1,950, debit. Supplies $1,300, prepaid insurance $3,600, equipment $7,200, then accounts payable $4,300, credit. Unearned revenue $800, credit. Owner's capital $15,000, credit. Drawings $1,050, back in the debit column. Service revenue $6,450, credit. Salaries $1,900 and rent $950, both debits. Now total the two columns, $26,550 and $26,550. Look at that, equal to the dollar. Take the win, and honestly, if you are still here working along with a pencil, you are doing better than most of my classroom ever did. But do not celebrate too long, because here comes the twist of Chapter 3. A trial balance can balance perfectly and still be wrong. Still with me? Good, because this next stretch is where the grade is decided, and it is the heart of Chapter 3. How can a balanced trial balance be wrong? Because some of its numbers are stale. Look at the evidence. Supplies says $1,300, but we have been burning brake pads all month. Prepaid insurance says $3,600, but March protection is fully used. The equipment has quietly aged a month. Half the club's bikes are already tuned. The mechanic has worked 2 weeks we have not paid for, and one finished repair has not even been billed. None of those events moved cash, so the journal never saw them. They are quiet truths. Adjusting entries are how the books catch up to the truth at March 31st. There are exactly 4 families. Prepaid expenses, the cost you paid first, and that family includes supplies, insurance, and yes, even depreciation, because the equipment is just one more thing the shop paid for up front. Then, unearned revenues, accrued revenues, and accrued expenses. Every adjusting entry ever written belongs to one of these. Every single one touches one income statement account and one balance sheet account, and not one of them ever touches cash. 6 adjustments are waiting for us. Slow down and stay with me here, future CFO. In my classroom, this stretch is where the A students were made. Adjustment 1. Supplies. On March 31st, Sam counts the shelf, and $450 of pads and cables are still sitting there. Baby steps now. What did we buy in total? $1,300. What is still on the shelf? $450. So what got used? $1,300 minus $450. $850. $850. Say it twice. $850. Gone into customers' bikes over the month while nobody was writing entries. The pantry emptied quietly. Now derive the entry with the Chapter 2 questions. Supplies. Expense goes up. Expense up means debit. The asset supplies goes down. Asset down means credit. Debit supplies, expense $850, credit supplies $850, and watch it land. Supplies drops from $1,300 to $450, which is exactly what the count found. That is the proof. And here is what breaks if we skip it. Expenses would be missing $850. Profit would look $850 richer than it is, and the balance sheet would brag about supplies that are already bolted onto someone's bike. That is why this entry exists. And if that felt slow, good. Slow is exactly how this sticks. Adjustment 2. Insurance. And you already know this story, it is the freezer. The policy costs $3,600 for 12 months of protection. So 1 month costs $3,600 divided by 12, $300. March is over, 1 slice has been eaten. Insurance expense goes up, debit. The asset prepaid insurance goes down, credit. Debit insurance expense, $300. Credit prepaid insurance, $300. The asset slides from $3,600 to $3,300. 11 slices left, 11 months of protection the shop still owns. Same Chapter 3, skeleton as supplies. The cost moves off the shelf and into expense exactly when the benefit gets used. Never sooner, never later. 2 adjustments down, and the next one introduces somebody new. Adjustment 3, depreciation, and this one brings a brand new character to the stage, so slow down with me here. The equipment cost $7,200. It will serve the shop for about 36 months. Same freezer logic as the insurance, and file it where it belongs. This is not a new family. Depreciation lives inside prepaid expenses. The equipment is just one more cost Sam paid up front. March used up 1 month of it. $7,200 divided by 36 is $200 of equipment, life consumed. Depreciation expense, up $200, debit. But now the new part, and listen closely. We do not credit equipment. We credit a brand new account called accumulated depreciation. It is a contra asset. Think of it as a little odometer riding next to equipment. It counts up everything that has ever been used. Why keep an odometer instead of just writing the car down? Because the balance sheet wants both facts. What the equipment cost, $7,200, and how much is used up so far, $200. Erase the cost, and you erase the story. And one more thing, you never roll an odometer back. That is fraud at a car lot, and it is fraud here too. So, debit depreciation expense, $200. Credit accumulated depreciation, $200. On the balance sheet, they stand together. Equipment at cost, $7,200. Less accumulated depreciation, $200. Book value, $7,000. From my classroom days, this credit line was missed more than any other line on any exam. Students credit equipment directly. Do not do it. The odometer takes the credit and the car keeps its sticker price. Adjustment 4. Back to the Ridgeline Cycling Club and their gift card. They paid $800 for 10 tune-ups, and by March 31st, 5 bikes are done. Half the work is delivered, so half the debt has been worked off. 5 bikes at $80 each. $400 is now earned. Derive it. The liability shrinks. Liability down means debit. The revenue is born. Revenue up means credit. Debit unearned service revenue $400. Credit service revenue $400. The gift card balance drops to $400. 5 tune-ups still owed. And $400 of honestly earned revenue joins the income statement. Notice the direction flipped. The first 2 adjustments moved costs off the shelf into expense. This one moves debt into revenue. Deliver the work first, then it becomes revenue. Same sentence as March 8th, now cashed in. Adjustment 5, and this one is about work we have already done, but have not billed yet. In the final week, Sam finished a complete overhaul on a customer's cargo bike. $650 of work. Done, delivered, and the invoice simply has not gone out. Work delivered means revenue earned, and Chapter 3 does not care that the paperwork is running late. So an asset goes up, accounts receivable, debit, and revenue goes up, credit. Debit accounts receivable, $650. Credit service revenue, $650. Watch accounts. Receivable climb from $1,950 to $2,600. That is an accrued revenue. The revenue first and the cash later. Revenue when earned, not when billed and not when paid. The last adjustment, and it is the mirror twin of the one we just did. This time, we are the ones who owe. The mechanic worked the whole back half of March, $750 of labor, and payday is not until April. No cash is moved, but the expense already happened. The shop consumed those hours in March, so March must record them. That is an accrued expense, the expense first and the cash later. Salaries expense up $750, debit, and a brand new liability called salaries payable, up $750, credit. Debit salaries expense $750, credit salaries payable $750. Now look at the true cost of March labor. $1,900 paid plus $750 owed, $2,650. That is what the month really cost. And that is all 6 adjustments, the full set. The prepaid family did the heavy lifting, supplies, insurance, and the equipment's depreciation. The club's advance moved from unearned to earned, and 2 accruals caught reality up, the cargo bike and the mechanics tab. Now look back across all 6 and notice the promise held. Not one of them touched cash. Not one. Before we list anything, let us post those 6 adjustments to the ledger, the same way we posted the 12 transactions. Same T accounts as before, and only 11 of them are touched. And they are laid out in the same order as everything else tonight, the expanded accounting equation. Assets, then liabilities, then revenue, then expenses, which means the top row is every balance sheet account, and the bottom row is every income statement account. Watch each one. Accounts receivable had $1,950. Adjustment F adds $650, giving $2,600. Supplies had $1,300. Adjustment A takes $850 out, leaving $450. Prepaid insurance had $3,600. Adjustment B takes $300 out, leaving $3,300. Accumulated depreciation starts from nothing and picks up $200 from adjustment C. Then the liabilities. Unearned revenue had $800. Adjustment D moves $400 out, leaving $400. And salaries payable is born at $750. Now the bottom row, the income statement. Service revenue had $6,450. Adjustments D and F add $400 and $650, and it climbs to $7,500. Salaries expense had $1,900. Adjustment E adds $750, giving $2,650. And the last 3 are brand new expenses. Supplies expense $850, insurance expense $300, depreciation expense $200. Now notice something. 5 of these 11 accounts did not exist an hour ago. The adjustments created them. Every balance on this page is now true, and the adjusted trial balance is nothing more than this ledger listed out. Trial balance, round 2, the adjusted trial balance. Same single list, same 2 columns, same chart of accounts order, but now every stale number has been refreshed. Watch the lines the adjustments moved. Accounts receivable is $2,600 now. Supplies is $450. Prepaid insurance $3,300. Unearned revenue $400. Salaries expense $2,650. And service revenue $7,500. Then look at the rows that are brand new. Accumulated depreciation $200. Salaries payable $750. And 3 new expense lines: supplies, insurance, and depreciation. Now total both columns. Debits $28,150. Credits $28,150. Balanced again, and this time it is better than balanced. It is true. And here's why this one list matters so much. All 3 financial statements read straight off it. That was the hard part of the night, and you did it. Statement 1, the income statement. The question it answers: did March make money? And notice the form, because presentation earns marks. 2 columns. Revenues first. Service revenue $7,500, and that figure sits in the outer column on its own. Then a separate expenses section, and every expense gets its own line in the inner column. Salaries $2,650, rent $950, supplies $850, insurance $300, depreciation $200. Rule them off, add them up, and carry one number out to the outer column. Total expenses $4,950, sitting directly under the revenue. Now the 2 outer figures subtract cleanly. $7,500 minus $4,950. Net income $2,550 under a double rule. TrueWheel's first month turned a real profit. And notice what is not on this statement. No drawings, because Chapter 1 taught us a drawing is not an expense. No cash balance, because cash is not income. And read the heading, for the month ended March 31st. This statement is a movie of the whole month, not a photo of one day. Its bottom line is about to walk straight into the next statement. Statement 2, the statement of owner's equity. The story of Sam's steak, told in 4 lines. It started at 0. The business did not exist in February. Sam invested $15,000. The shop earned $2,550. And there it is, the net income walking in from the income statement. This handoff is exactly why the statements must be built in order. And Sam took out $1,050 in drawings. So $15,000 plus $2,550 minus $1,050. Ending capital $16,500. Profit feeds the steak. Drawings drain it. And that $16,500 is the exact figure the balance sheet is waiting for. Statement 3, the balance sheet, the photograph of exactly where TrueWheel stands at midnight, March 31st. And we present it classified, which means the accounts are grouped, not just listed. Current assets first. cash $8,600, accounts receivable $2,600, supplies $450, prepaid insurance $3,300, subtotal that group. Total current assets, $14,950. Then a second group, property, plant, and equipment. Equipment at cost, $7,200. Less accumulated depreciation, $200. And watch how that is presented. The $7,000 simply carries out to the outer column. We do not write the words book value on the face of the statement. Carrying amount is something you say, not a line item you type. Total assets, $21,950. Now the claims. Current liabilities, accounts payable $4,300, unearned service revenue $400, salaries payable $750, total current liabilities $5,450, then owner's equity, Sam Doyle Capital $16,500, delivered straight from statement 2, and the closing caption, total liabilities and owner's equity $21,950. Stop and stare at that for a second. 12 transactions, 6 adjustments, 3 statements later, and the equation from minute 1 of chapter 1 still holds to the exact dollar. Assets equal liabilities plus equity. It never tipped once, and you just built that line by line, future CFA. That is not luck. That is double entry doing precisely what it was built to do. One job remains. The income accounts did their work for March, but April deserves a clean scoreboard, so we close the books. Closing empties every temporary account, the revenues, the expenses, the drawings, and it pours the result through a funnel called income summary into capital. 4 entries, always the same 4, in the same order. No rush here. We take them one at a time. 1. Close revenue. Debit service revenue, $7,500. Credit income summary, $7,500. And the revenue account now reads 0. 2. Close the expenses. All 5 in one compound entry. And notice each expense gets its own line, never lumped together. Salaries, $2,650. Rent, $950. Supplies, $850. Insurance, $300. Depreciation, $200. Credit every one of them down to 0. And debit income summary for the total, $49.50. Now look inside the funnel. It holds $7,500 of credit against $49.50 of debit. A credit balance of $25.50. Recognize that number? Net income, computed a second independent way. 3. Pour it home. Debit income summary. $25.50. Credit owner's capital, $25.50. The profit officially belongs to Sam. And 4. The famous trap. Drawings does not ride the funnel. It is not an expense. It never touches income summary. It closes straight against capital. Debit owner's capital, $1,050. Credit owner's drawings, $1,050. From my grading days, that 4th entry was the most reliably botched line on the entire paper. Funnel for income, straight line for drawings. And here they are, all 4 together, in order. Revenue into the funnel, expenses into the funnel into capital, and drawings straight against capital. Screenshot that. Those 4 entries close every set of books you will ever touch. The victory lap, the post-closing trial balance, a list of the survivors. Every temporary account now reads 0, so what remains is permanent. The balance sheet family only. On the debit side, cash $8,600, accounts receivable $2,600, supplies $450, prepaid insurance $3,300, equipment $7,200. On the credit side, accumulated depreciation $200, accounts payable $4,300, unearned service revenue $400, salaries payable $750, and owner's capital $16,500 with March's profit sealed inside it. Total the columns $22,150, both sides equal. The books are closed level and loaded for April. And that, start to finish, was the full accounting cycle. Here's exactly how exams will use it against you. Small questions pull out one station. Journalize this transaction. Prepare that adjusting entry. The big final question hands you a month exactly like ours and asks for the entire ride. We have full mock exams built on exactly this at optionflowtracker.com, plus practice exercises, chapter quizzes, and a quiz generator that writes fresh questions on demand. Every bit of it is free, and the link is in the description. And here it is, the card I promised you at minute 1. Chapters 1 to 4, one screen. Section 1, record. The equation, the dealer map, and the 4 questions that wrote every single entry tonight. Section 2, adjust. The 4 families of adjusting entries with their skeleton moves. Prepaid costs. And remember, depreciation lives inside that prepaid family. Then unearned revenue, accrued revenues, and accrued expenses. And the one rule, no adjustment ever touches cash. Section 3, report and close. The statement order, income, then equity, then balance sheet. the 4 closing entries with the drawings trap flagged in red, and the 3 trial balances of the night all balanced to the dollar. Pause the video right now, screenshot this card, and keep it in your camera roll for the exam. And before you go, the whole course in one sentence. Every transaction keeps assets equal to liabilities plus equity. Adjusting entries just make the books tell the truth on time, and closing hands the profit to the owner and resets the scoreboard. That is accounting 1. That is what you just did. All of it. Yourself. Every expert you admire once sat exactly where you are sitting right now. So keep pushing. Future CEO. The only difference between you and them is the next chapter. Before the last screen, 1 minute, the entire cycle, out loud. Station 1, journalize, 12 transactions across March, and every single one of them came from 4 questions. Which accounts, which direction, which rule, debit first. Station 2, post. Every journal line flew home to its own account page, and cash landed on 8,600. Station 3, the trial balance, 26,550 on each side, balanced, and still not true. Station 4, adjust, 6 entries, letters A through F, 4 families, prepaid costs with depreciation living inside them, unearned revenue earned, accrued revenue, accrued expense, and not one of them touched cash. Station 5, the adjusted trial balance, 28,150 on each side, and now every number is true. Station 6, the statements, in order, net income 2,550, owner's capital 16,500, and a balance sheet that lands on 21,950 on both sides. Station 7, close. 4 entries, the temporary accounts emptied, and a post-closing trial balance of 22,150. Look at what that list actually is. 3 separate proofs at 3 different moments, and the books held every time. That is the whole cycle. Run this same month once on your own paper, start to finish, and chapters 1 to 4 are genuinely finished. The full problem set is waiting for you on the site, free. If tonight made the course click, the subscribe button keeps the next chapter coming. And if any journal entry tonight felt shaky, watch debits and credits next. We just published it. It runs 5 minutes, and it is the exact skill every entry in this video stands on. The full Accounting 1 playlist is free after that, in order, chapter by chapter. Everything we used tonight lives on the website. The mock exams, the practice exercises, the quiz generator, all of it free. The link is in the description. I read and answer every question below, so ask me anything about tonight's problem. I mean that. Thanks for working all the way through this with me, and I will see you in the next chapter.